Quality investing has gained a lot of popularity over the last few years. I noticed more and more investors coming up on X, on YouTube, everywhere, being quality investors, willing to pay up for quality. And that's really an amazing strategy, and it has worked really, really well. But if you look at the strategy over the last year and a half, 2 years, it hasn't really worked too well. And I don't believe it's being talked about enough. So if you look at SPGI, for example, S&P Global, this is one of the highest quality companies you could buy. S&P Global is down 21% over the last year. Moody's is also down about 6%. It is down actually much more from its all-time high. But I think investors are not appreciating enough how those stocks used to trade. Like, you would be lucky to get a dip on Moody's or S&P Global. And if you do get a dip, it gets bought up within the first few hours or within the first day or two. You had no time to buy the stock. But the fact that you could buy Moody's and S&P for the same price you could have bought them at a few months ago really tells you how uninterested people are in those quality stocks. You could also look at Intuit. Intuit has given up all of its gains over the last 5 years. It's down 60% from all-time high after being a quality company, worth paying up for quality because of the network effects and because of how sticky the product is. Well, this one has also been underperforming. MasterCard is another quality company. You couldn't, again, get a dip on MasterCard. Now you could buy MasterCard for the same price you could buy it at a few months ago. And MasterCard is down 12%. But the biggest one of them all is FICO. FICO is down 28% over the last year. It's down 50% from all-time high after trading at 80 times earnings. From 80 times earnings to 25 times earnings. So I believe there's something that has clearly went wrong for all those stocks and all of this strategy to underperform in such a major way while the S&P is making new all-time high and while many stocks are making new all-time highs. And I want to talk about this today and talk about the psychology of it and the cycle of those investment strategies. And I really hope you enjoy it as always. Now, based on my time in the market, I noticed that every few years you tend to have a new market team or a new market strategy that emerges, and everyone wants to follow the strategy. For example, before 2020, it was mainly a lot of dividends. So people were interested in dividend stocks. Dividend investors were getting so many views on YouTube that it's not even funny. There still are. There's still an audience for it, but it's not as big as it was before. From 2020 to 2022, we had the growth stock investment team where people want to be growth investors. But a lot of the growth stocks went down 50-70% in 2022 and never recovered. So people switched away from growth investing to quality investing. And quality investing is mainly paying up for a good company. So you don't buy a bad company that's declining in revenues. You don't buy a growth stock that's unprofitable, but you buy a high quality company with a very wide moat, with amazing competitive advantages, with high return on capital, with decent growth, with a great management team. And even if this company is overvalued or not undervalued, you could still pay up for it and you will make money over time. Because again, Terry Smith said that you could have paid 200 PE for L'Oreal, I don't know, 20 years ago. And even if you pay 200 PE, you still outperform the S&P 500. So a lot of people were following this team. And this one, again, became so popular that you had an account on X called Compounding Quality. Once he was coming up on X and he was getting so much attention for quality investing, he had the picture of Warren Buffett. And he became so popular that someone from Warren Buffett's office messaged him, emailed him, and I told him, please, could you take the picture down? Because we don't want Mr. Buffett being misrepresented by another account, because no one knew who this guy was. So he had to take down a picture of Warren Buffett. And then he got a sponsorship offer from Volkswagen. Now, you could tell me what is the relationship between quality investing and Volkswagen. And once I saw this ad, I was like, this is the peak of quality investing. There's just no way. I mean, this is what happened. This is how popular this investment strategy was. And again, it hasn't really worked too well over the last few years. Terry Smith, which again is the biggest quality investor you could imagine, He's facing outflows. His assets went from 20 billion to 12 billion in 2 quarters. And that wasn't because those stocks have declined in value so much. It was because of outflows. People are seeing the underperformance and they're pulling their money out. Same thing with Dev. Dev is someone that a lot of people follow on YouTube. Well, he hasn't also been doing too well. FICO has underperformed, S&P Global, MasterCard, Moody's, Visa, Intuit, everything except ASML. Everything else has done really, really poorly. And you also have Chuck Akre, another really popular quality investor. Chuck Akre's ETF, since he launched it over a year ago, it has also underperformed. So I believe there's two reasons for that. And I think there's a lesson in general that I believe will likely make this investment strategy a little bit better. Now, one reason for this underperformance is the fact that now we have AI, and AI stocks are very, very popular. And there's only so much money in the market. So once the money is going into something, it's likely coming out of something else. For example, investors right now don't find Moody's, which is a rating agency, too attractive. It's not attractive to them. For example, Nvidia maybe is more attractive to them, or AMD, or something that's betting on AI. And this is something that I noticed, which I believe now the investment team, the popular one, is betting on thematic. So betting on teams, AI, robotics, things like that. And ultimately speaking, people will also pay up for the team because of unlimited time on robotics. And then those stocks will pop, and then we'll have a new investment team. So that's how it's been working. But generally speaking, when you have only so much money in the market, it goes into something, it comes out of something else. I always like giving the example of the NASDAQ and Berkshire Hathaway in 1999, when Berkshire declined like 50%. And the NASDAQ was making a new high. And Berkshire has declined not because they were doing poorly financially in 1999, but because people were selling it to buy pets.com and Medscape and all those .com kind of name, because Berkshire was not excited enough. And then once that bubble popped, Berkshire has recovered. So this is something that I see all the time, where the money, for example, goes into Nvidia, it comes out of Coca-Cola, then Nvidia goes down and Coca-Cola goes up, or McDonald's, and you could really see it playing out in real time. But I believe this is a more extreme one with a lot of the quality stocks. And I think the money will come back in the quality stock once the AI rally cools off. And I think it could potentially happen as soon as next year, with the political backlash that's been happening and a lot of states wanting to ban the construction of data centers. So this bubble, I should say bubble, but this trend will ultimately slow down. And I think once that happens, people will look at amazing companies like Moody's and S&P Global, and maybe they'll start to put some money into them. So this is a really big one. But I believe the biggest mistake that quality investors in general made is they focused too much on quality and too little on price. And this is another mistake that value investors make, is they focus too much on price and not enough time on quality. Now, the best way to do it, in my opinion, is to combine them together, to combine quality investing and value investing in what I would call quality at a reasonable price. So a quality company is amazing. You have to look at the quality of the business. You have to look at the moat, the competitive advantage, high return on capital. But the valuation also matters. And what value investors look for, they look for what they would call a margin of safety. So let's say this is the intrinsic value of the company. Most quality investors would buy it right at intrinsic value because maybe they're fearful it's never going to go down and because it's a good company and all of that. Well, value investors look for what they would call a margin of safety. So they want to buy below intrinsic value if the multiple contracts, if the company doesn't deliver on guidance, if something happens, you have some kind of a cushion, okay? So let's say, for example, the stock is trading at 200, okay? Your intrinsic value is at 200. Maybe you could take a 10% margin of safety and put in a buy price of $180. This way you have that 10% cushion. Now, even if you buy it at $180, it could still go to $120 or $100. You can't predict those things, but at least you would have caused a little bit less damage than buying it at 200, if you buy it within a 10% margin of safety. Or maybe, for example, also position sizing helps. So starting a small position if the stock is not too undervalued, and then leaving room if it goes down, you're happy the stock went down, you buy more, you feel better that you lowered your cost basis, and you build up the position slowly. This is another way for having a margin of safety. But I think, again, the biggest mistake that was made is by looking at a lot of those stocks like Costco and the stocks that never go down and trying to compare every other stock to Costco and saying this is the next Costco. That's normally like the biggest mistake people make in investing. I remember back in 2021, every stock on YouTube was the next Tesla because, again, people have recency bias. Tesla played out, so NEO is the next Tesla, XPeng is the next Tesla, this is the next Tesla, and none of them ended up being the next Tesla. So we have to be careful when we look at Costco and try to say, oh, Costco is a quality company trading at 50p, so this also deserves to trade at a higher multiple, and try to rationalize higher multiples. I think that was the biggest mistake made, and I believe that that's what really happened here. But I just wanted to talk about it a little bit, try to document what happened in quality investing. Again, I'm not against the strategy at all, and I have some of the quality investing stuff in my portfolio, but I try to do a little bit of a better job at paying attention to the price. If it gets too expensive, I trim them. If they go down, I add more, and that's how I personally manage it. But that was my opinion on this whole strategy and the team in general. Hope you enjoyed it. It was not financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.